Moment. Let me see if I can make this bigger. There we go. I see me. Anyways, welcome to this week. This week we're going to be talking about the new stimulus law and how the one that passed just in December, and some of the changes that are going to affect even for the return that we're going to be filing in the next 3 or 4 months. Okay. Make sure you look at last week's. I talked about the changes on and the new PPP loan and what it takes to be required. If you if you think you qualify, you need to look. All right, because it's that's what I'm working on right now. All right, remember that one. You got to have less. Watch last week's. I'm not going to do a repeat of it. But I mean, what it really comes down to is if you qualify, you better get your application in soon. I'm anticipating it won't disappear as fast as it did before. The first time last year, the first one disappeared like in 2 3 weeks. The second one took a couple 3 months. I think it's going to be somewhere in between. The banks are more efficient. They know the rules. More people, more business owners are familiar with it. I'm getting a lot of phone calls. But things that are going to make it reduce is you got to have a 25% decrease in 1 quarter. There's a bunch of other tricky rules if you weren't in business for all of 19. Get with somebody who knows what they're doing. Also, you can't have more than 300 employees, which is going to get rid of most of those big ones that went after it. And your what's the other one? Oh, maximum loan is 2 million, which means you're going to get rid of it. But inside that law, there was a lot of law changes that actually go into effect for 2020. And that thing was passed in the end of December. So what that's going to do, it's going to already, for example, right now, I can e-file business returns because there wasn't a lot of changes, but they have not yet allowed us to e-file individual returns. They haven't even told us when we're going to be able to yet. Okay, at least not as of a couple days ago. I'm guessing we're talking last week in January, probably, maybe even they might might put it out with a couple of changes that if you have these things, you have to wait even longer. That happened to us once 3 4 years ago, where the change was actually done in January, and it took the software companies and the IRS quite a bit of time to change the forms and catch up. So, what changed? Well, let's look at the first one. The charitable donations. Um, a lot of charities depend on donations, obviously. Well, up until 2018, 30% of taxpayers itemized, which was the only way to deduct a charitable donation. With the 2018 Tax Act, that changed, increased the standard deduction. That lowered to 10%. Only 10% of people are itemizing, which has hurt charities. So they stuck in something for 2020, which is an above the line deduction, which means whether I itemize or not, it goes pretty much in the same place an IRA or Educator Expenses go. I can get it of $300, so I can deduct up to $300. Now, they didn't do it correctly, kind of weirdly. That was in the CARES Act back in uh, April 3rd. In this latest one, they corrected it, but only for 2021, to say if you're married, you can do up to $600 by you can do up to $600, 300 for each of you, so it eliminates the marriage penalty. So in 2021, I can deduct up to $600 worth of charitable donations, even if I don't itemize. Now, interestingly, they put in a 50% penalty if you take that deduction and can't prove that you actually made the charitable donations. So you can be looking at a $150 or $300 penalty if you get caught just putting a number in there. Second thing, the AGI for charitable contributions. This doesn't affect a lot of people, but you have people in higher incomes that don't need the money. They give away a good chunk of their income. It used to be that I could only give away 50%. But that deduction went up to 60% of your adjusted gross income can be given to charities, and that's not including donor advised funds. But this increase was for 2020 only. The new law extended that to also deductions in 2021. To be honest, it's never really a good idea to give 100% of your income. I haven't seen it, but I have seen some people do some large amounts. Um, I'm not going to discuss that one because it's got nothing to do with it. I'm going to skip to the next one. Medical expenses. In order to deduct the medical expenses, it's really difficult. You had to have more than 7.5% of your income. So let's say I made $100,000. I had to have more than 7.5%. Now that was supposed to change to 10%, but they made that permanent. Um, September, let's see, compliance with yours. Whoop, I'm in the wrong place. Yeah, it was supposed to, for several years, fluctuate. It's been changing from 10% to 7.5%. Under the new law, the taxpayer made it 7.5 and made it permanent. Now, so that means if I spend $10,000 and I have $100,000 worth of AGI, take the 10,000 minus the 7.5 of 100,000. All I got to deduct was 2,500 because the first 7,500 I couldn't, and then I still had to make sure that I had enough to itemize. So there's a lot of planning opportunities. Really, if you know you're going to have a big surgery or anything, you probably want to get with your tax advisor and see if there's something you can do. Which leads me to the next one. One of the things you can do is if you're lucky enough to work for an employer who has a flexible spending account, usually you understand these. People in larger companies understand this more, where you can basically have you can have an amount taken out of your check for daycare, for your insurance, for health insurance, for various things, including medical. Then it would reduce your taxable income, and you could do it even if you didn't itemize. All right. The problem with it is it was a use it or lose it. If you didn't use it by the end of the year, you lost the money. So people didn't know what to put in there unless they, I think we used it one year when I was working for somebody. When my third child was born, we knew we were going to have some medical expenses, obviously, so that we knew. But unless you had a scheduled surgery or something, you didn't use it. Well, now under the new rules, what happened under regular tax rules, I could only carry $550 forward. Under the Taxpayer Certainty and Disaster Act, Tax Relief Act of 2020, which is the official name of what they called this last one, I can now carry any unused 2020 portion to 2021, and the remaining balance may be carried over to 2022. Now, another thing you can do if you're self-employed and you don't have a lot of employees, you might want to look at setting up a medical reimbursement account, which allows the employer to pay the medical expenses and deduct it without you having to put it on your income. Tricky. You need to give it somebody who knows what they're doing and can put the paperwork together, and you can't discriminate. So if you have 10, 15 employees, you got to offer it to all of them. That's why normally you don't do it, because you don't want to be on the hook for that. That's what insurance is for. Big one, even if you're not, if your income's too high, you probably just won't qualify to you, but you probably know somebody who's one of your employees or something who's a working, working what they call working poor. I don't know what that definition means anymore, but they have an amount. In other words, you qualify for the earned income tax credit. I just don't like that term, working poor. I mean, they're working. All right. I'd rather they would be working than not working, obviously. And one of the main things the tax code has to help them is the earned income tax credit and the child tax credit. Well, one of the things they recognize is that in 2019, they probably had more hours and more W-2s than they would have in 2020, because during 2020, because of the pandemic, they were probably laid off. So what they did is they made, and this is one of the things that's going to make it interesting, they made a change where, let me make sure I get the exact wording. For purposes of the EITC and the child, which is the earned income tax credit, and the child tax credit only, the new act that was just passed in December permits taxpayers to substitute their earned income for 2019 if it's greater than their earned income for 2020. All right, this gets a little tricky now. And that's why these software programs, even TurboTax and those guys, are having to scramble, because it just literally got passed and there was no notice this was going to be in there. It's a 5,000 page bill. They got to stop passing these monstrosities, but that's another topic for another day. When they pass a $5,000 bill, they can dump a bunch of pork in it, and that's what it takes for these guys to get a bill passed nowadays. Is all their friends have to be taken care of. And I'm not picking on one party or the other. They both are guilty of it. It's something that we got to fix in our system at some point, or we're all going to pay the bill. But what ends up, I didn't mean to get off on that track. What ends up happening is that the program is going to have to make the decision on whether you're better off. They're going to have to optimize it. Which one are you better off with, 2019 or 2020? Because sometimes the lower income is what you want. All right, because what happens is the earned income credit gets higher and higher until you get around 15 to 20,000, depending on how many kids. Then it starts to reduce as you get down to 40,000, where it eliminates depending on how many kids. And that it. I'm simplifying it. So you might get more if your income was at 30,000. If it drops to around 15, you might be better off using 2020. So don't. This is going to be tricky, man. People are going to have to be careful what they do, and make sure they go to somebody who knows what the hell they're doing and doesn't just stick numbers in there and say the program kicked out this. Make sure. It can be very tricky. Another thing, educator expenses. If you're a teacher or somebody that works in schools, you used to be able to $250 above the line, kind of like what I was talking about with contributions. Um, for teacher supplies and things that they pay out of pocket, which is a joke. My wife used to teach and she spent way more than $250. But that now has been included to include PPE stuff. So if you bought stuff like masks and stuff to clean the desk and all of that can be used, but only if it was bought after March 12th. And again, that adds up to $250. And big changes coming into effect for tuition and fees and the lifetime earning credit. This is an area that was really confusing, and they're trying to simplify it some, because I had the lifetime earnings, I had the deduction, and also had the one for the first 4 years. My brain stopped, which was higher. So the lifetime earning credit is, you can take whether you got a degree or not, and it's 20% of the first 10,000, which means you can take $2,000 right off your tax. The difference between a credit and a deduction is a credit's right off your tax. Sometimes if you were in a higher bracket, the deduction was better because the deduction was right off your bracket. But they got rid of that, okay? Under the new code, the tuition and fees deduction expires at the end of 2020, so this is the last year, all right? And the lifetime credit they've increased the phase out so it doesn't disappear as much. I'm not going to go into what the phase outs are and the dollars, because that'll just bore you. It's hard to do numbers without sticking them on the screen. So if you have that, you may win, you may lose. It kind of depends on your situation. Everyone's kind of there. Now, the biggest change I talked about last week, but I want to bring it up again. If you got a PPP loan, you were probably told that yes, when the law passed, it said it was non-taxable income. But they made a mistake, and another law said, prior law and prior IRS regulations said, and prior court cases said, that if you got non-taxable income that you used to pay deductible expenses, you weren't allowed to deduct the expenses. So if I got a $100,000 PPP, yeah, I didn't have to pick it up income, but I couldn't deduct $100,000 of salaries. Wasn't what they intended. They corrected this in this bill late December after I finished all my tax planning, because the world's playing with all us accountants the last 10 months, 11 months. So anyways, that's neither here nor there. But now it's not taxable income, and you can deduct all the salaries, and the same with the second PPP if you qualify. There's a lot. I mean, those are the major changes you kind of need to keep your eyes out on that snuck in on us in the last year. There's a lot more. I'll be honest, I can't think of a year other than major tax changes like 2018 in the 90s. It happens usually every 20, 30 years. But this one, this last year, there's a lot of changes. If you're thinking about doing your own return, you might want to be careful. If you're thinking about going to H&R Block and those guys, Liberty Tax and Jackson Hewitt, some of them are pretty good, some aren't. So be very careful if you got anything tricky. Make sure you're going with somebody who knows what they're doing. Hey, this is Wayne Bilal saying, until next time, let's make this our most profitable year ever. And next week we'll get back to talking about how to increase profits, which is what we need to do, especially in a tough economy. Thank you very much, and we'll see you then.